Welcome to the deep dive. We have built this specific session entirely for you, our listener, to really shortcut your way to being the most well-informed person in the room today.
That's right.
Let's set the stage. Today is Tuesday, March 11th, 2026. And sitting on the desk between us is just this towering stack of today's business dailies.
That is quite a stack.
Yeah. We're looking at pages from the Business Standard, Mint, the Economic Times. And looking across these front pages, the news reads less like a dry financial report and a lot more like a high-stakes geopolitical thriller.
It truly does. It's one of those rare days where the headlines at the very top of the front page are just forcefully trickling down into the absolute minutia of the markets,
Right.
corporate strategies, and even, honestly, what you can realistically order for lunch at your neighborhood restaurant. The interconnectedness is on full display today.
It really is. So the mission for today's deep dive is to navigate this incredibly turbulent intersection of global geopolitics and your local pocketbook. We are going to connect the dots between these unprecedented airstrikes in the Gulf, the price and availability of a local dosa, massive wealth erosion in the IT sector, and a profound reversal in foreign direct investment laws.
It's a massive amount of ground to cover.
It is, but we are going to break it down piece by piece.
And what's fascinating here is how quickly global macro shocks are currently filtering down into microeconomic realities for Indian businesses and consumers.
Yeah, the speed is crazy.
We often talk about the global economy as this vast, slow-moving ship. We assume there's a lag between a headline in Washington or Tehran and a factory floor in Chennai.
Right, you'd think it takes months.
But today's sources show us that the transmission mechanisms are operating at lightning speed.
Now, before we jump into the deep end, I do want to acknowledge a crucial rule for our deep dive today.
Absolutely vital.
The sources we are working from contain very intense, rapidly developing geopolitical news regarding a major conflict involving the U.S., Israel, and Iran. As always, we are here to impartially report the facts exactly as they are presented in these business dailies. We are taking absolutely no sides, nor are we endorsing any political or military viewpoints.
Right.
Our sole job today is to analyze how these events are impacting global markets, supply chains, and the underlying economy.
That is the exact lens we need to use. Our focus is strictly economic. We'll look at the math, the physical movement of goods through supply chains, and the shifting psychology of the markets.
So let's start with the dominant headline across all these papers, which is the escalating conflict in West Asia.
It's everywhere.
It really is. The reports describe what Iran has called the most intense day of U.S. airstrikes. And the sources detail Iran's stated strategy, which is essentially a calculated war of attrition.
Right.
They are wagering that they can endure the military strikes and outlast the U.S. and Israel by aggressively disrupting vital energy routes. They're aiming to jolt global markets so hard that it forces a diplomatic or military pullback.
And that strategy hinges on one critical geographic bottleneck, which is the Strait of Hormuz.
Yeah.
Given how closely you follow the markets, listener, you know the importance of this narrow waterway connecting the Persian Gulf to the open ocean. It handles roughly 20% of the world's daily oil supply.
20%.
It is the jugular vein of the global energy market. And according to the reports today, this vital artery is effectively shut down.
Which is terrifying for the markets.
Completely. Iran's Islamic Revolutionary Guard Corps, the IRGC, has explicitly threatened that not 1 liter of oil will be allowed to leave the region if the attacks continue.
Wow.
They are directly targeting the global economic nervous system, knowing full well that oil-importing nations are highly vulnerable to sudden supply shocks.
Which brings us to the crude oil roller coaster, because the numbers here are just staggering.
They really are.
Brent crude, the global benchmark, surged to $116.80 per barrel on Monday. It was looking like a doomsday scenario for oil-importing nations like India.
Because higher crude directly translates to higher current account deficits.
And imported inflation. But then, by today, Tuesday, it suddenly retreated. It fell back to around $86.60 to $90 per barrel. That's a 3.13% drop.
Yeah.
How does oil drop that fast when the Strait of Hormuz is essentially closed?
It's a really fascinating mix of algorithmic trading, shifting market psychology, and the physical reality of strategic reserves.
Okay, break that down.
Well, markets are forward-looking mechanisms. Right now, traders are betting heavily that U.S. President Donald Trump will move to end the war very soon.
Interesting.
The sources indicate he suggested military operations are progressing ahead of his initial 4 to 5 week timeline. So the commodity markets, which price in risk premiums by the millisecond,
Right.
They're pricing in a quick diplomatic or military resolution rather than a protracted multi-month disruption. When the narrative shifts from an indefinite blockade to a 3-week disruption, the speculative premium on that barrel of oil collapses very quickly.
But hope isn't a physical barrel of oil. You can't refine political signaling into aviation fuel. There has to be physical math acting as a cushion here, too.
Right? That's the core issue. The safety net here is substantial. The U.S. holds about 415 million barrels in its Strategic Petroleum Reserve, USPR.
415 million.
And on top of that, the International Energy Agency, the IEA, coordinates the holding of about 1.2 billion barrels globally among its member countries.
That's a massive buffer.
It is. These aren't just numbers on a spreadsheet. This is physical crude sitting in salt caverns and massive storage tanks ready to be deployed.
Right.
So even if the flow from the Gulf stops entirely for a short period, these reserves provide a profound psychological and physical buffer against immediate catastrophic shortages. The market looked at the pace of those potential reserve drawdowns, looked at the political signaling from the White House, and basically stepped back from the ledge.
And you can see that step back perfectly reflected in the domestic equity markets today. The markets just breathe this massive collective sigh of relief.
They really did.
Just a day after falling to a 10-month low, the markets rebounded hard. The benchmark Sensex jumped 640 points, or 0.8%, to close at 78,206.
A huge swing.
The Nifty 50 gained 234 points, a 1% jump, settling at 24,262. In a single trading session, the total market capitalization of BSE-listed companies swelled by nearly 6 trillion rupees.
Which brings the total to around 447 trillion rupees. And if you look at the underlying data, the most telling metric might actually be the India VIX.
The fear gauge.
Exactly. This index effectively functions as the market's fear gauge, measuring the near-term volatility expectations priced into option contracts. It plummeted by 19.1% to settle at 18.9.
Wow, a 19% drop in fear, essentially.
Yeah. And bond yields also eased, with the benchmark 10-year government bond settling at 6.67%, down from 6.72%.
So what are the mechanics there?
They're straightforward. Softer crude prices ease fears of imported inflation, which in turn takes the pressure off the Reserve Bank of India to keep interest rates aggressively high.
Right.
When the market believes interest rates won't be hiked to combat oil inflation, bond prices rise and yields fall.
But this raises a vital question for you, the listener, as you look at your own portfolio today. Is this relief rally actually sustainable? Or are the equity markets wearing rose-colored glasses and severely underpricing the risk of a prolonged closure of the strait?
That is the big question.
Because I'm looking at a prominent quote here from Wood Mackenzie analysts, and they are warning that if that strait remains closed, Brent could easily push to $150 a barrel in the coming weeks.
That is the multi-trillion-dollar question right there. The equity market is currently pricing in a swift conclusion. If that assumption is wrong, and this grinds into a months-long war of economic attrition, that physical buffer we talk about will start to look very, very thin. You can only draw down the SPR so fast, and eventually it needs to be refilled. A $150 barrel of oil would fundamentally rewrite inflation projections across the entire globe. It would force central banks to pivot back to hawkish stances, crush corporate operating margins, and likely trigger a severe recalibration of equity valuations.
So the market is currently walking a tightrope of optimism over a chasm of geopolitical risk.
Perfectly said.
Now, shifting from the abstract world of global oil markets and bond yields to the very real physical world of the domestic economy. The papers are full of reports about a severe crisis hitting the hospitality sector.
Here's where it gets really interesting for the everyday consumer.
Definitely. We are seeing shrinking menus, night food deliveries being abruptly halted, and roadside dhabas literally shutting their doors in major metros like Delhi, Chennai, and Mumbai. The root cause: a sudden, crippling shortage of commercial liquefied petroleum gas, or LPG.
This illustrates that rapid transmission mechanism we discussed earlier. LPG and piped natural gas, or PNG, are heavily reliant on imports. India imports a significant percentage of its LPG requirements, primarily from the Middle East. So when the Gulf supply chain seize up and vessels cannot safely transit the region, the local distribution network feels it almost immediately.
The buffers just aren't there.
Exactly. The buffers at the retail distribution level are not designed to withstand a total stoppage of incoming shipments. The National Restaurant Association of India, the NRAI,
They represent a massive number of restaurants, right?
500,000 restaurants across the country.
Oh.
They were forced to issue a frantic advisory to their members. They're officially telling restaurants to suspend items that require slow cooking, deep frying, or the use of multiple burners simultaneously.
There's an incredible detail buried in the Mint coverage regarding the Adyar Ananda Pavan chain, widely known as A2B.
Oh, yeah, I saw that.
They employ around 15,000 people across their network. They've had to downsize their menu by 50% and actively reduce the hours they serve dosas because the preparation requires continuous high-heat gas usage.
They're simply running out of fuel.
Furthermore, in Delhi, a black market has already sprung up practically overnight, with commercial cylinders selling for 400 to 500 rupees above the regulated rate. The sources explicitly note that dishes like biryani are essentially being taken off menus just to conserve gas.
It is a textbook supply shock.
Mm-hmm.
And it forces both businesses and governments into immediate triage mode.
Right.
Because you cannot just let the hospitality sector, which employs millions of daily wage workers and drives massive consumption, collapse.
Obviously not.
But simultaneously, you cannot let residential households go without cooking gas, nor can you let fertilizer plants shut down, which would trigger a cascading food security crisis months down the line when crop yields plummet.
So the government has to make agonizing choices about who gets priority access to a scarce resource.
Exactly.
And the sources detail exactly how the government is executing this triage. Prime Minister Modi directed key ministries to cushion the impact, resulting in a fresh, strict priority order for natural gas diversion.
Let's hear the numbers.
Here is the hierarchy of who gets gas right now, according to the Economic Times. Domestic PNG, CNG for transport, and residential LPG production get 100% of their past 6-month average consumption. They are fully protected at the top of the pyramid.
Makes sense.
Next, fertilizer plants get 70% of their average consumption. Finally, tea estates, general manufacturing, and other industrial consumers are cut down to 80% of their historical usage.
And the corporate sector is actually being drafted into this crisis response as well to augment supplies.
How so?
Well, Reliance Industries, RIL, announced they are maximizing LPG production at their Jamnagar refinery complex. They're running those specific units at absolute peak utilization.
Okay.
They are also diverting natural gas produced from their deepwater KGD6 basin specifically to support these priority domestic sectors, shifting it away from other potential industrial uses.
So it's an all-hands-on-deck situation.
Very much so. Simultaneously, the Ministry of Petroleum is scrambling to secure additional LPG and liquefied natural gas supplies from non-Hormuz routes. They're looking at spot cargoes from the U.S., Australia, or West Africa to bypass the conflict zone entirely.
Though securing spot cargoes in a panic market comes at a steep premium, I imagine.
A very steep premium.
So if domestic households are getting 100% protection, someone else has to absorb the shortage, and the industrial fallout is becoming severe. The papers point specifically to the ceramics and tiles sector, companies like Kajaria Ceramics and so many.
Right.
To understand why, you have to look at their cost structure. Power and fuel account for 20 to 25% of their total production costs because firing kilns requires immense continuous heat.
Yeah.
With gas supplies constrained by that 80% quota and spot market prices highly volatile, equity analysts are already projecting a significant margin hit for these companies in the upcoming fourth quarter of FY26.
And the packaged food companies, the FMCG sector, they're also seeing their operations squeezed as their PNG and commercial LPG supplies dwindle, impacting their baking and processing lines.
It just cascades everywhere.
It does. But what is truly alarming is the compounding effect of these crises on export-heavy industries that rely on complex logistics. Take the Kolkata leather hub, for instance.
Yeah, the coverage of the Kolkata leather industry is sobering. This hub supports an estimated 700,000 livelihoods, heavily skewed toward the export market.
Huge.
They were already stretched thin by new reciprocal tariffs imposed by the U.S., which is their largest destination market. Now they are facing a logistical nightmare.
Air freight is paralyzed.
Completely. The sources note that air freight, often used for high-value or time-sensitive fashion consignments, is completely paralyzed due to the airspace restrictions over the West Asia conflict zone. Commercial airlines have suspended flights or drastically rerouted, removing massive amounts of belly cargo capacity from the market.
And ocean freight offers absolutely no relief.
Because of the rerouting.
Yes. Costs have surged 3 to 4 times their normal rate, because shipping lines are having to reroute vessels around the Cape of Good Hope at the southern tip of Africa to avoid the Red Sea and the Gulf of Aden entirely.
Let's unpack the mechanics of that detour for the listener.
Going around the Cape of Good Hope adds roughly 10 to 14 days to a transit from India to Europe or the east coast of the U.S.
That's a huge delay.
It burns significantly more bunker fuel. But more importantly, it ties up shipping capacity. If a ship takes 2 weeks longer to complete a round trip, it isn't available to pick up its next scheduled load in Mumbai or Chennai.
Right, the containers are just stuck on the water.
This creates a cascading global shortage of empty shipping containers and available vessel space.
Which impacts everyone.
Exactly. The Auto Components Manufacturers Association, ACMA, has sent an urgent SOS to the Ministry of Heavy Industries regarding this exact issue. They're warning of severe export delays for their members, surging logistics costs that destroy their competitiveness, and disruptions in importing the critical raw materials needed to keep their assembly lines running.
The government has to be incredibly agile to navigate a macro environment this hostile, and that agility is perfectly demonstrated in a monumental policy reversal regarding foreign direct investment, specifically concerning China.
This is arguably the most structurally significant piece of news in the entire stack of papers today,
Right.
with implications that will stretch far beyond the current geopolitical crisis in the Gulf.
It's massive.
The Union Cabinet, chaired by the Prime Minister, has officially eased the restrictions on investments from countries sharing land borders with India. They have amended what is widely known in the corporate world as Press Note 3 of 2020.
Let's give the listener some crucial historical context here. Press Note 3 was introduced in April 2020. This was during the height of the first wave of the COVID-19 pandemic, and the explicit stated goal at the time was to prevent opportunistic takeovers of vulnerable Indian companies by foreign entities whose valuations had crashed. However, it gained immense geopolitical weight shortly after, following the tragic India-China border clashes in the Galwan Valley in June 2020. Under those Press Note 3 rules, any foreign direct investment from a bordering country, which, for all practical purposes, meant Chinese capital required prior strict government approval.
It did not matter which sector the investment was in or how small the stake was.
Every single proposal had to go through a rigorous, often opaque, interministerial security clearance process. It essentially froze Chinese capital and joint ventures out of the Indian startup and manufacturing ecosystems for years.
And now, nearly 6 years later, they are executing a profound pivot.
Why now?
Well, the new amendment allows investments from these land border countries to proceed through the automatic route, meaning no prior government approval is needed from the security apparatus, as long as the investment is for non-controlling stakes below a 10% threshold.
But they didn't just crack the door open, they installed a speed lane. The amendment introduces a definitive 60-day timeline for processing investment proposals that still require government approval in very specific strategic sectors.
Yes.
Electronic components, capital goods, and solar cells. Why those specific sectors?
This highlights a fascinating tension in India's overarching economic strategy. India desperately wants to position itself as a premier global manufacturing hub, a viable alternative to China in global supply
You
chains.
see that everywhere.
The government has poured billions into production-linked incentive, or PLI, schemes to achieve this. But to build a true manufacturing ecosystem, you need massive amounts of capital. And more importantly, you need advanced technological components, tooling, and deep supply chain integration.
You can't just build the final product out of thin air.
Exactly. Right now, China heavily dominates the global value chains for the raw materials and intermediate components needed for electronics, solar cells, and heavy capital goods. The government has realized a hard truth. Keeping Chinese capital and technological expertise completely locked out was actually bottlenecking India's own manufacturing ambitions. You cannot assemble smartphones competitively if you cannot easily import or co-manufacture the display modules and semiconductor packaging.
So it is a deeply pragmatic, calculated move. The government is essentially saying, we still want to protect our domestic companies from hostile, controlling takeovers, which is why the automatic route is capped at a 10% non-controlling stake. But we absolutely need your technology transfers and your joint ventures to build our own factories and scale our PLI schemes.
It brings vital predictability back to the negotiating table. For the last 6 years, Chinese investment proposals, even benign ones for minor component manufacturing, could languish for over a year waiting for interministerial approvals.
Just stuck in bureaucratic limbo.
Exactly. A strict, mandated 60-day timeline gives global funds, multinational corporations, and potential joint venture partners the certainty they need to actually allocate capital and execute on technology transfers and manufacturing collaborations on Indian soil.
We can clearly see the immediate impact of that Press Note 3 amendment on the stock market today. But before we look at the specific companies benefiting from this policy shift, we have to examine a staggering wealth erosion in a different sector.
Yes.
Let's look at the IT sector's $100 billion warning.
This is a metric that demands absolute attention. The market capitalization of Tata Consultancy Services, PCS, the absolute flagship of the Indian IT services sector, has fallen by more than $100 billion from its peak in January 2022.
$100 billion in wealth erosion for a single company.
It's hard to even wrap your head around.
At its absolute high, TCS was valued at $200.15 billion. It was a historic moment, as it was only the second Indian company ever to cross that $200 billion threshold, right behind Reliance Industries.
Right.
But at the latest close reported in today's papers, its market cap stood at roughly $99 billion. It had been cut in half. And the analysis in the sources points out that this isn't just a cyclical downturn driven by macroeconomic shifts or clients delaying discretionary spending due to high interest rates.
No, this is much bigger.
This is an existential crisis brought on by the rapid maturation of artificial intelligence.
The structural uncertainty in the market right now is profound. Traditional Indian IT services, the giants like TCS, Infosys, and Wipro, built their empires on an outsourcing model.
Right, body shopping.
They provide massive, highly trained teams of engineers for software maintenance, routine coding, quality assurance testing, and vast back-office business process operations. Investors are looking at the rapid advancements in large language models and generative AI, and they are aggressively repricing the future cash flows of these IT giants.
Because the AI can do the work?
If an enterprise client can deploy an AI copilot to write baseline code, debug software patches autonomously, and manage Tier 1 customer service without human intervention, what happens to the massive billing hours that form the lifeblood of an IT services firm?
The fear is that the traditional model, where revenue scales linearly with headcount, is fundamentally broken.
Yes, and while the IT firms are undoubtedly pivoting, investing heavily in training their workforces on AI and launching their own AI-driven platforms, the market is deeply skeptical.
About the margins.
Exactly. They doubt whether the margins on AI consulting will ever match the sheer volume of revenue generated by traditional maintenance contracts. The market doesn't have a clear answer on what the terminal growth rate of these companies looks like anymore. And in the absence of that clarity, institutional investors are fleeing the stock, leading to this historic $100 billion markdown.
Now, contrasting that unprecedented erosion with an incredible surge, shares of Dixon Technologies zoomed 12.8% on Tuesday, closing at over 10,918 rupees.
A massive jump.
The catalyst for this massive spike. The Ministry of Electronics and IT, MeanID, officially approved Dixon's joint venture with HKC Overseas to manufacture LCD and TFT LCD modules.
This is where we see the immediate, tangible result of the Press Note 3 framework changes we discussed earlier. Dixon is a premier Indian electronics contract manufacturer. HKC Overseas is a major global player with deep expertise in display technologies.
So they're teaming up.
This joint venture, operating under a 74.26 equity structure in favor of Dixon, brings critical display manufacturing technology directly onto Indian soil.
The projected numbers on this joint venture are substantial. The first phase aims to create local capacity to manufacture 24 million smartphone displays and 2 million notebook displays annually.
That's just the first phase.
Eventually, they want to scale that up to 55 to 60 million units. Analysts at Nomura weighed in on this, noting that assembling display modules locally, rather than importing them fully finished, can potentially add 50 to 100 basis points, meaning 0.5% to a full percent to Dixon's overall operating margins.
Which is huge in contract manufacturing.
It is a vital step up the value chain, from basic assembly to complex component integration. It proves the government is eager to greenlight strategic tech partnerships that boost domestic value addition and reduce import reliance.
It is a clear, flashing signal to the broader market. Companies that can successfully navigate these complex joint ventures, secure the necessary government approvals under the new timelines, and bring advanced component manufacturing into India will be handsomely rewarded by both the regulatory apparatus and institutional investors.
Let's look at the turmoil in the aviation sector now, which is taking hits from multiple directions.
Rough week for the airlines.
The sources report that Indigo's CEO, Peter Elbers, has resigned abruptly, effective immediately, citing personal reasons. Promoter Rahul Bhatia is stepping in as the interim CEO to manage the transition. This creates a significant leadership vacuum at the worst possible time for the airline.
The timing is highly concerning for shareholders. This resignation comes just 3 months after Indigo suffered a catastrophic operational meltdown in December 2025, where widespread fog, crew scheduling issues, and network congestion forced them to cancel over 4,200 flights in a single week.
Oh, I remember that. It was chaos.
The airline was just beginning to stabilize its operations, revamp its scheduling algorithms, and regain consumer trust. Losing your chief executive, the person architecting that recovery in the middle of a global energy shock, creates immense strategic vulnerability.
And speaking of that energy shock, Air India is taking defensive action. They announced a phased introduction of fuel surcharges on domestic and specific international tickets starting tomorrow, March 12.
Which makes sense given the input costs.
Aviation turbine fuel, or ATF, accounts for nearly 40% of an airline's total operating costs in India. With the Gulf conflict spiking benchmark crude prices, airlines simply cannot absorb the margin hit. They have to pass it directly onto the passenger.
It highlights the extreme fragility of airline profitability models. They operate on razor-thin margins and are highly susceptible to exogenous macro shocks, like a sudden spike in crude oil or the closure of massive swaths of airspace over the Middle East that they have absolutely zero control over.
Right.
A fuel surcharge might protect margins temporarily, but it also risks dampening passenger demand if ticket prices rise too high.
We have a few other important corporate developments to highlight from the stack today.
Yeah.
French automaker Renault announced an aggressive future-ready plan targeting 2 million vehicle sales globally by 2030, and they're heavily relying on India as one of their 3 primary global production hubs outside of Europe, signaling long-term faith in Indian manufacturing capabilities.
Good news for domestic manufacturing.
Definitely. Meanwhile, Bajaj Auto is officially evaluating options to expand the production capacity of its Chetak electric vehicle line to meet rising domestic demand, showing the EV transition continues despite broader macro headwinds.
Also positive.
In the food and consumer sector, Imami Agritech is aggressively targeting a 2,000 crore turnover, specifically from the HoReCa segment, hotels, restaurants, and catering, which is an interesting play given the current LPG shortages crippling that exact sector.
Very interesting timing for that push.
And finally, a harsh reminder of international counterparty risks. IT firm Sonata Software has been forced to file a $10.65 million bankruptcy plea in a U.S. court against a retail client over unpaid dues. This shows that the macro slowdown in the U.S. retail sector is directly impacting Indian balance sheets.
Those updates really illustrate the diverse cross-currents in the economy right now. You have heavy, long-term investments in EV capacity and global manufacturing hubs on one hand, and the immediate reality of client bankruptcies, margin pressures, and supply chain bottlenecks on the other.
Let's shift our focus to how the big money and the government are positioning themselves amidst these cross-currents. The papers highlight the immense portfolio impact on the Life Insurance Corporation of India, LIC, leading up to this war shock.
The numbers here are sobering.
LIC, which is the largest institutional investor in the Indian equity market, saw a staggering 70,105 crore rupee erosion in its stock portfolio in just the week leading up to the conflict.
To put that in perspective, that is nearly an $8.5 billion mark-to-market hit in a matter of days.
Just evaporating.
Exactly. The sources break down exactly where that pain was concentrated. Over a fifth of this loss, about 15,293 crore, was localized entirely in major banking stocks, specifically State Bank of India, ICICI Bank, and HDFC Bank.
Why were the banks hit so aggressively by institutional sellers before the airstrikes even began?
Because banking stocks are highly sensitive to inflation and interest rate expectations. When rumors of a major Gulf conflict begin to circulate, the commodity market immediately prices in higher oil. Higher oil means higher imported inflation for India.
Right.
When inflation expectations rise, the market assumes the Reserve Bank of India will be forced to keep interest rates higher for a longer period to cool the economy.
Which hurts credit growth.
Higher interest rates can dampen corporate credit growth, increase the risk of non-performing assets, and pressure the net interest margins of the banks. Furthermore, higher rates mean the massive portfolios of government bonds held by these banks lose value.
Ah, I see.
The market anticipates this entire hawkish cycle and aggressively sells off banking stocks to reduce exposure.
But the single biggest corporate loser in LIC's portfolio wasn't a bank. It was Larsen & Toubro. L&T alone accounted for a 7,609 crore loss for LIC. The reason why is a perfect lesson in geopolitical risk assessment.
It really is.
75% of L&T's massive international order book is located in West Asia, with their largest exposure being complex hydrocarbon sites and infrastructure projects currently under execution in Saudi Arabia.
When a war threatens to engulf the entire Middle East, investors immediately discount the future earnings of any company heavily concentrated in that geography.
They just pull out.
Analysts are already warning of potential execution delays on those hydrocarbon projects, force majeure clauses being invoked, disruptions in moving labor and materials to the sites, and a likely deferral of fresh contract awards by governments in the region until the geopolitical dust settles.
Right.
It is a prime example of how geographic concentration, which was a source of immense growth for L&T over the last decade, can become a systemic risk practically overnight.
But while the institutional giants like LIC were taking hits and foreign portfolio investors were likely pulling capital, the sources reveal a surprising silver lining regarding domestic retail investors.
This is a great data point.
Despite the global panic and the Sensex initially plunging to a 10-month low, domestic retail investors held the line. Active equity mutual fund schemes actually saw net inflows increase by 8% in February to roughly 26,000 crore.
That is a remarkable statistic that speaks to a profound structural shift in the India market, and the data shows it was largely driven by a 13% decline in redemptions.
Meaning people just didn't sell.
Even though new systematic investment plan, or SIP, registrations dipped slightly during the truncated month, existing investors overwhelmingly chose not to pull their money out during a time of immense fear.
That's huge.
It speaks to a growing maturity among Indian retail investors. They are looking past the short-term geopolitical noise, trusting their fund managers, and adhering to long-term wealth creation strategies. This domestic capital is acting as a crucial shock absorber, providing a buffer against the volatility traditionally caused by foreign capital flight during global crises.
Now, looking at the government's balance sheet, the center is seeking Lok Sabha approval for a massive 2.81 trillion rupee additional expenditure for FY26 through a supplementary demand for grants. Where is all that additional capital being routed?
A significant portion of that 2.81 trillion is being routed to cover elevated fertilizer subsidies and necessary defense spending.
Fertilizer is directly tied to this, isn't it?
The fertilizer subsidy is directly linked to the energy crisis. When global energy prices spike, the cost to produce urea and import essential fertilizers skyrockets. To protect the agricultural sector and prevent a collapse in crop yields, the government absorbs that cost difference, shielding the farmers from the global market rates. This requires expanding their revenue expenditure significantly, which is what this supplementary demand represents.
And speaking of protecting the agricultural sector, we have some fantastic news on that front. India's wheat production is officially estimated at a record 120.21 million tons for the 2025-26 crop year.
That record harvest is the ultimate macroeconomic defense mechanism.
It's a huge buffer.
When global supply chains are disrupted, logistics costs surge, and energy prices are volatile, the risk of imported food inflation is immense. Food constitutes a massive portion of the Indian Consumer Price Index basket.
Right.
Having a profound domestic buffer of a staple crop like wheat provides vital stability. It keeps domestic food prices manageable even when global commodity markets are in chaos, which gives the central bank much more breathing room when setting interest rates.
Let's touch on one final, sobering reality check from the corporate sector before we wrap up our analysis. A report by the CFA Institute was released today focusing on corporate governance and gender diversity. The numbers are frankly abysmal.
They are.
Women hold only 12.4% of key managerial personnel, or KMP, positions in FY25.
The underlying data in the report is even more striking. It found that almost two-thirds of the sampled firms have 0 women in key managerial posts.
0.
For every 7 male KMPs, there's less than 1 female KMP. It is a stark reminder that while the Indian economy is modernizing rapidly in terms of technology, AI adoption, and complex manufacturing joint ventures, structural inclusion and diversity at the highest levels of corporate leadership are still lagging severely behind global standards.
When we synthesize all of the reporting, the geopolitical shocks, the policy pivots, and the corporate maneuvers from today's stack of dailies, a few distinct themes really jump out for anyone managing a long-term portfolio. Let's walk through the 10 most critical developments for you, the listener.
Let's do it.
First, the most obvious takeaway is the geopolitical risk premium. The wild swings in Brent crude prove beyond a shadow of a doubt that any energy-dependent portfolio must permanently factor in persistent Middle East volatility. The era of assuming stable, cheap energy flows from the Gulf, unbothered by conflict, is just over.
Building on that, the second theme is supply chain vulnerabilities. Companies that are heavily reliant on the Red Sea and the Strait of Hormuz, whether that is L&T's massive Middle East project order book, or the auto component exporters in Kolkata facing surging freight costs around the Cape of Good Hope carry profound systemic geographical risks that must be heavily discounted in their long-term valuations.
Third, we have to look at the FDI policy pivot. The easing of Press Note 3 is a structural tailwind for Indian electronics, capital goods, and solar manufacturers. Companies like Dixon Tech that are actively securing global tech partnerships and joint ventures are positioned for significant margin expansion as they move up the value chain.
Fourth, there is the immediate energy input margin squeeze. Heavy industrial consumers of natural gas and LPG, such as the ceramics industry, the hospitality sector, and packaged foods, face severe near-term margin compressions due to the supply rationing. This crisis will clearly separate the market leaders who have the pricing power to control costs from the laggards who cannot absorb the shock.
Fifth is the IT sector's AI repricing. TCS's staggering $100 billion wealth erosion signals a permanent market reevaluation. The traditional IT services outsourcing model is facing an existential threat from generative artificial intelligence, and investors are demanding clarity on what future growth and billing models will actually look like.
Sixth is aviation fragility. Indigo's abrupt leadership vacuum with Peter Elber's resignation, combined with Air India's immediate implementation of fuel surcharges, highlights a painful truth. Airline profitability remains highly, almost uniquely, susceptible to exogenous macro shocks like fuel spikes and airspace closures.
Seventh, and perhaps the most encouraging, is domestic retail resilience. The 8% growth in mutual fund inflows during a week of global panic is a watershed moment. The Indian retail investor is providing a strong structural buffer against foreign capital flight, fundamentally lowering the overall volatility of the domestic equity markets.
Eighth, we see clear fiscal support vectors. The government's supplementary demand for 2.81 trillion rupees confirms their ongoing commitment to fiscal support for the rural economy, particularly by absorbing the global shock of fertilizer prices to protect farmers and ensure food security.
Ninth, providing further stability, is the agricultural buffer. The record 120.2 million ton wheat harvest acts as a crucial domestic hedge. It ensures that even if global energy and shipping costs skyrocket, domestic food inflation remains anchored.
And finally, the 10th theme is regulatory rigor. The papers highlight the Income Tax Department aggressively chasing brokers for excess securities transaction tax, and the RBI aligning market risk capital rules with stringent global standards. Regulatory compliance costs are permanently shifting upward for financial institutions across the board, and that will inevitably impact their bottom lines.
That is a comprehensive framework for digesting today's news.
I want to leave you, the listener, with one final provocative thought to mull over today. We all watched global supply chains completely rewire themselves during the pandemic out of sheer necessity.
We did.
Today, reading through these sources, it is abundantly clear we are seeing them rewire again, this time due to entrenched geopolitical conflict and strategic decoupling. This new reality is forcing governments to actively, aggressively manage their economies. They're deciding who gets priority access to cooking gas and who gets the green light to build electronics with foreign partners. So ask yourself, as an investor, are you still valuing companies based on an era of frictionless, free-flowing global trade? Because looking at the geopolitical realities on these front pages, that era no longer exists.
An incredibly important question to consider as you review your own strategies. Thank you for joining us on this deep dive. Remember, the global economy moves incredibly fast, but taking the time to stay deeply informed is the absolute best investment you can make. We will see you next time.